Hello guys, I hope you all are doing well. It's been long I dropped a video on this channel. So in this video today guys, I took a trade since yesterday. So I wanted to show you guys the reason why I took the trade, what I saw on all the criteria I did follow before taking the trade, because I feel that it's going to be beneficial to a lot of us here on this channel. So that was why I decided to do the video. So I've been holding the trade since yesterday, quite a number of hours, and it was actually quite a simple trade that I took, because I just followed one simple criteria actually. But before I show you the criteria guys, I want to bring your attention to my Telegram channel. Recently I've been dropping signals on the channel. For futures trading. I don't know if you guys have any knowledge on that, futures trading. So if you are interested in trading the futures, please join the channel. I've been dropping signals there consistently, so join the channel so that we make money together. The link is down there in the description of this video. So back to the video, the main topic of today. So this is volatility 100S index on the 4-hour time frame. A lot of you guys ask me down there in the comment section of this video that whichever strategy you are using, do I need to check on the higher time frame? And my answer is always yes. Of course, you always have to check the higher time frame before you make your entries on the lower time frame, because the setup the market is going to give you on the higher time frame is always much more valid than the setup the market is going to give you on the lower time frame. So for example, you might go to your high time frame, you might go to your lower time frame, and then you see that the market is actually bullish. But unfortunately, when you check out on the higher time frame, maybe the 4 hours time frame or the daily time frame, you realize that the market is not actually bullish, rather the market is bearish. So that bullish movement you are seeing on the lower time frame is actually a little retracement that is happening on the higher time frame. So you guys actually need to watch out. Whichever strategy you are using, always analyze the market from the higher time frame. It gives you more accurate entries, more valid setups, and all that. So back to the topic of today. What did I actually see before making this entry? So what I saw was actually that I came to my 4 hours time frame, and I saw that the market was actually very bearish. It was very bearish, guys. As you guys can see, a bearish market forms higher high, higher low, higher high, lower high, lower low, lower high, lower low, lower high, lower low, all the way down to the current market price. Lower high, lower low, and all that. Lower high, lower low, lower high. So when before I made the entry, the market formed this lower high, this particular lower high here. The market formed this lower high already, and it did formed this lower low. So when I saw this, the next thing let me delete these lines so as not to confuse me. So immediately after saying that, the next thing I thought of was that, okay, since the market is actually in a downtrend, that means it's going to be forming lower high and lower lows. So it already formed the lower high here and the lower low here. So that means the market is going to retrace back up a little bit before dropping again. So what did I do? I immediately brought out my Fibonacci. I don't know if you guys know about Fibonacci retracements too, but this is it. So when I brought out my Fibonacci, I drew it from this last lower high down to this lower low. That was exactly what I did. Sorry for that. That was exactly what I did. So I drew my Fibonacci from the last lower. Sorry for this, guys. I'm trying to make it okay. So I drew my Fibonacci retracement tool. So what is the use of this Fibonacci? What is the use of Fibonacci actually? So this Fibonacci is actually a tool, retracement tool. It's actually a tool that is actually very, very useful in a trending market. Only a trending market, guys. Is a tool that is actually very, very useful in a trending market. You shouldn't use a Fibonacci in a ranging market, a market that is consolidating. Rather, use it in a trending market. Because what does it do? This Fibonacci tool actually gives you an idea of when a retracement is actually over, and let's say for example the market is actually bullish, so it's forming higher high, higher low, higher high, higher low. So as it's going up, it's definitely going to retrace before it's definitely going to retrace down before shooting up again. So that potential temporary downward movement the market is making, Fibonacci actually gives you an idea. Okay, this is the end of that downward movement, so you can actually decide to buy from here and then start riding all the way up. The same thing for a bearish market. Market is forming lower high, lower low, lower high, lower low, lower high, lower low. So as the market is going down, it's definitely going to go up a little bit before it continue pushing down. So that's temporary up push the market makes. There's actually a limit to that. So a Fibonacci retracement tool gives you an idea, okay, that this is where the market is actually going to stop retracing from, and then it will begin shooting downwards. So this is basically what a Fibonacci retracement tool does. So this is the exact principle I used. So as I saw that the market was actually a downtrend and is forming a lower high and a lower low, so the next thing I thought of was, since the market has formed a lower high here and it came all the way down to form a lower low, that means it's going to retrace back up a little bit before it begins coming down again. So I immediately brought out my Fibonacci retracement tool, as I just did here, and then I marked out this zone. What did I mark out? You see, the Fibonacci tool has two segments actually, the 50% upward and the 50% downward. From 50% upward or from 50% downward. So these two segments are actually called premium and discount. So from 50% up, from 50% here, from here all the way up is premium, and then from 50% down, from 50% here all the way down is called discount. So you want to sell from the premium side and then you want to buy from the discount side. I don't know if you guys understand. Even in an ideal market, you would want to buy when the price is discounted, and you would want to sell when the price is premium, right? So that is the basic ideology behind Fibonacci retracement tool. So what are your golden zones? Actually, as you guys can see, there are so many levels on the Fibonacci retracement tool. But what are the golden levels? Like, which level should you watch out for? So my golden levels are the 50 level and the 61.8 level. Guys, whenever you are using a Fibonacci retracement tool, the moment market retraces all the way to your 50, in between your 50 to 61.8, just know that is a golden zone. And what should you expect? You should expect that the market should continue its trend from there. If it's a bullish trend, it should continue going up. If it's a bearish trend, as in this case, it should continue pushing down. So that is exactly what happened. So when I marked out my Fibonacci, I saw that the market was here. As you guys can see, let me zoom in. I realized that the market was already here. The market was already in between this is the 61.8 level and this is the 50 level. So the market was already here. As you guys can see, this week the market entered between the 50 and 61.8 and it started coming down. So what did I do? So the moment I saw that, I entered the trade here. I entered the trade exactly here, and as you guys can see, it was actually a sniper entry. And ever since I entered the trade, it didn't actually retrace up. It retraced up a little bit and then it started pushing down. It was more of like a sniper entry, and I've been holding the trade. As you guys can see, I'm still on the trade. Let me go back to the 15 minutes time frame. So this is the trade. This is the trade, guys. This is the trade. This is the 15 minutes time frame. Let me delete this Fibonacci so that you guys can see. This is the 15 minutes time frame, and this is the trade. This is the trade. I entered the trade around here, and then as you guys can see, it was actually a snapper entry because there was no actually retracement all the way up here or anywhere. The moment I entered, it dropped, came back close to my entry level, and then continued dropping, and it's still dropping. And I'm not going to exit this trade till I'm sure that I actually make a lot of money, till the market reaches a point whereby, till it reaches a zone whereby I know that, okay, I need to go out of the market right now. Maybe a strong demand zone. So this is just the basic principle I used to enter this trade, guys. I hope you guys understand what I'm trying to, the information I'm trying to pass in this video. So if you enjoyed the video, please like the video. If you've not subscribed to the channel yet, subscribe to my channel. I've been dropping good videos like this, and I shall continue dropping good and better videos like this. So this is what I have for you guys today. Thank you guys for watching, and I will see you guys in the next video.